Welcome back to Make Finance Easy. Today's video is going to be on revenue, cost of goods sold, or also known as COGS, and profit margins. These are three very main concepts that show up everywhere in finance, accounting, business analysis, and even investing. So by the end of this video, you'll understand how they connect and why they matter. Let's start with revenue. Revenue is the total amount of money a business earns from selling its goods or services. Think of it as a top of the line income system. If a coffee shop sells 1,000 coffees at $5 each, its revenue is $5,000. An important point is, revenue does not mean profit. It just means how much money comes in before expenses. Next is cost of goods sold, or COGS. COGS include direct costs required to produce the product or service a company sells. For a coffee shop, the COGS would include coffee beans, milks, cups, and lids. For a clothing company, it would include fabric, labor to make the clothes, and factory costs. What doesn't count as COGS though? Things like rent, marketing, office salaries, and utilities. These are operating expenses, not production costs. Now, let's put revenue and COGS together. When you subtract COGS from revenue, you get gross profit. Let's use our coffee shop example. The revenue was $5,000, but then our COGS is $2,000. So you get a gross profit of around $3,000. This tells us how much money the business keeps after paying the product itself, but before paying other expenses. This brings us to profit margins. A profit margin shows profit as a percentage of revenue, which makes it easier to compare businesses of different size. First and most common is gross profit margin. Gross profit margin is basically the gross profit divided by revenue times 100. So in our example, we got a gross profit of $3,000 and a revenue of $5,000. So let's do 3,000 divided by 5,000, which is 0.6. But once you times that by 100, it's 60%. That means for every dollar the coffee shop earns, it keeps 60 cents after covering production costs. So why does this matter? A higher gross margin usually means the company has pricing power, production is efficient, and costs are well controlled. But a lower gross margin could signal rising material labor costs, heavy competition, forcing lower prices, inefficiency in production. So different industries have very different margins. For example, grocery stores have very low margins, often under 5%, though a software company can have very high margins, sometimes over 70%, because once the product is built, it's cheap to sell again. So margins should always be compared within the same industry. Now let's connect everything quickly. Revenue tells you how much money is coming in. COGS tells you how much it costs to make what you sell. And profit margins tell you how efficiently the company turns sales into profits. If the revenue is growing, but the margins are shrinking, that could be a major red flag. But if the revenue is stable and margins are improving, that's often a strong positive side to invest in that company. So to wrap up, revenue is the starting point. It's basically just the total amount of money a business earns from selling its goods or services. COGS show the production cost, and profit margins reveals the overall business's efficiency. These three numbers together give you a powerful snapshot of a company's financial health. Thanks for watching Make Finance Easy. If this helped, like, subscribe, and I'll see you in the next video.